Home Depot is arguably one of the best brick and mortar retailers in the world. Of course, it's behind companies like Costco and Walmart, but it certainly ranks up there in the top 10 of best brick and mortar businesses in the world, especially given its ability to withstand the onslaught from Amazon. And so, understandably, investors are interested in Home Depot stock as a potential investment for dividend investors or just growth stock investors because Home Depot is both a growth stock and a dividend stock. In this video, I will evaluate Home Depot across a number of critical financial metrics, including revenue growth, the inventory turnover ratio, which is very important for brick and mortar businesses like Home Depot, its returns on investor capital, and I'll look at the valuation. I did a discounted cash flow valuation model on Home Depot stock, which I'll share with you in this video. And I'll also look at the company's forward price to earnings ratio, and then finally answer if I think the stock is a buy after evaluating all of these figures. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Looking at Home Depot's revenue growth over the previous decade, we see an interesting previous 5 years out of those 10. And the pandemic created these unprecedented circumstances for Home Depot. The company thought that its sales were going to crash as a result of the lockdowns and the pandemic. But surprisingly, home improvement spending soared during the pandemic, and Home Depot notched several quarters of over 20% revenue growth, which the company hadn't done at any point in the previous decade. So it experienced a few quarters of a boom time during the pandemic. And then as economies reopened, you see that downtrend here. That's when people started to spend more time and money away from home. And also because people spent so much time and money on home improvement during the pandemic, there weren't very many things to fix up during that moment when economies reopened. So people had already painted their house, they maybe added a home office, they maybe upgraded their bathrooms and kitchen. And so when economies reopened, people shifted their priorities on spending time and money on other categories. And that lasted for a few quarters, and Home Depot demonstrated negative revenues year over year for several consecutive quarters. But now it looks like things are rebounding again for Home Depot. As you can see, revenue growth soars to 14%. So it looks like those times are behind Home Depot where it was experiencing the fallout from the elevated spending in 2020 and 2021. And now it's returning to growth, which is great news for investors. So while Home Depot's revenue growth has returned, its operating margin expansion has not. So you could see the company had done an excellent job expanding margins all the way throughout the previous decade until that economic reopening took hold, and that reversal, that revenue decrease, deleveraged the business, and its operating margin started to turn downward. Not all that much, right? From about 15.5% to 13.5%, but it stopped that longer term trend of expanding margins. That being said, if its revenue growth persists at anywhere near 6 or 7% per quarter, which it had done on average before the pandemic, it was an annual grower of about 7 or 8%. And I'm reasonably confident the company can return to those levels of growth. That will return the company's margins to the upward trajectory. Now, interestingly, the inventory turnover ratio is one number that I evaluate for any time I'm looking at a brick and mortar business. Of course, no business is only brick and mortar nowadays. Most businesses, even Costco, have a prominent online presence. But for the most part, Home Depot generates more revenue from its physical locations than it does in the website. So I like to look at the inventory turnover ratio, and it's still relevant even if you have a website business because you're still managing inventory. But I just think it's more important if you have a brick and mortar presence. It really shows me how good you are as a merchant. It shows me how good you are at finding products your customers want to buy, placing them and displaying them in the way your customers find attractive, and selling them at prices your customers find attractive as well. And so it includes a lot of things that demonstrate skill in your level of being a merchant. And that's what I look for when I'm looking for this kind of a business. And Home Depot's inventory turnover ratio is pretty strong. The most recent inventory turnover ratio was 7. That compares well with its main competitor, which is Lowe's, and it's always been better than Lowe's. Over the last decade, it's demonstrated a better inventory turnover compared to Lowe's. So that's a strong indication that Home Depot manages the business better than Lowe's. It's one strong indicator. Home Depot's returns on invested capital had been excellent until that economic reopening. Again, the revenue decreases has caused this metric to decrease, but still 27% is excellent. And I'm reasonably confident that when or as the company persists in this revenue growth, it will return its ROIC back to the upward trajectory, back over 35, 36%. Now, another thing that makes it impressive is that Home Depot's ROIC is almost 3 times its weighted average cost of capital, which is an important indicator for increases in shareholder wealth. Is a company's ROIC greater than the WACC? Home Depot has a nearly 3-to-1 ratio, which is excellent, premier in the category. And so that's great news. However, when I did my discounted cash flow valuation model, which is what you're looking at here, I found the intrinsic value per share, which is basically what I think Home Depot stock is roughly worth today, at $309. Well, the current market price is $384. So it looks like it's overvalued according to my calculations on the DCF. Now, when I looked at Home Depot's valuation on a forward price to earnings at 23, going back a year, that's about the lower end this stock has traded for. And a forward PE of around 23 for Home Depot, I would say, is fairly valued to slightly undervalued, given the positive trends Home Depot has demonstrated for the previous decade. And if we sort of minimize the impacts of the pandemic, both the ups and the downs, if we minimize those impacts in relation to evaluating the business, Home Depot is growing revenue at about 8% annually. Home Depot's operating margins were expanding towards 20%. Its returns on invested capital were up towards 40%. So certainly the company deserves a valuation, a forward price to earnings valuation closer to 27, 28, given those metrics. But right now you can get it for 23. So the valuation gives us a mixed result between, and I would say it looks between fairly valued to being slightly overvalued when incorporating both my discounted cash flow model and the forward price to earnings model. And so given all those gives and takes, given that its margins are still falling, its return on investor capital are still falling, and the valuation evaluation gives us a mixed picture, I'm going to keep Home Depot stock rated as a hold for now. I'm going to keep following this company because this is one that I'm really interested. I'm hoping to be able to have an opportunity to buy Home Depot stock at a better valuation. And so I'm going to keep an eye on this one for the next few quarters. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.